Have you ever wondered why so many traders lose money on what seems like a perfect breakout setup, only to watch the price collapse back into the trading range moments after they buy? What if I told you this isn't random market behavior, but rather a deliberate, orchestrated plan by the market's most powerful players? In the fascinating world of technical analysis, few approaches have stood the test of time like Richard Wyckoff's methodology. Developed nearly a century ago, Wyckoff's insights into market behavior remain strikingly relevant today because they address one unchanging truth. Markets are manipulated by large, informed financial interests. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You spot a stock that's been consolidating sideways for months, then suddenly it breaks above resistance on what looks like strong momentum. You jump in, convinced the new uptrend has begun, only to watch in dismay as the price immediately reverses, trapping you and countless others at precisely the wrong moment. This isn't coincidence. It's by design. Wyckoff's genius was in developing a methodical science for market analysis, focusing specifically on those critical transitions where stocks emerge from sideways trading ranges into powerful new uptrends. These precise moments represent extraordinary opportunities for investors who can properly identify them, but only if you can distinguish genuine breakouts from deceptive ones. At the core of Wyckoff's approach is the concept of the composite man, a theoretical entity representing the collective actions of large, informed financial interests. When you understand that markets move based on the deliberate campaigns of these powerful players, everything changes. Your perspective shifts from being at the mercy of seemingly random price movements to recognizing the footprints of smart money. Stay with me until the end of this series, because what you're about to discover might completely transform how you view chart patterns forever. The breakout, that moment when price finally surges above resistance, isn't the beginning of the story as most believe, but rather the culmination of a carefully orchestrated accumulation campaign. It signals that the composite man has completed his patient acquisition of shares and is now ready to engineer the markup phase where prices will be driven substantially higher. But here's the critical question most traders never learn to answer. How can you tell the difference between a genuine breakout that marks the beginning of a powerful uptrend and a deceptive upthrust designed specifically to trap unwary buyers? The answer lies in learning to read the subtle but unmistakable clues that reveal the true intentions behind price movement. If you found value in these Wyckoff insights, hit that subscribe button to join our community of serious market students. We're uncovering these hidden patterns together, one video at a time. The truth is, these false breakouts are not accidents. They're deliberate traps set by sophisticated players. The market's hidden truth is that false moves, what Wyckoff called upthrusts, are carefully designed manipulation tools with a specific purpose to mislead the public into buying at precisely the wrong time. This creates the necessary liquidity for large operators to distribute their shares at premium prices before the inevitable decline. Think about the psychological journey most traders experience. You've been watching a stock consolidate for weeks or months. Patience wears thin. Then suddenly, movement. The price pushes above resistance and you feel that familiar rush of FOMO. This is it. You think, the breakout I've been waiting for. You buy immediately, not wanting to miss the opportunity, only to watch in horror as the price reverses almost instantly. This mental battlefield is where most retail traders lose the war. But Wyckoff's methodology offers a profound transformation in how we approach these critical market junctures. Instead of making emotional decisions based on hope or fear, he developed a systematic verification approach that brings clarity to chaos. What makes Wyckoff's method so powerful is that it doesn't rely on indicators that lag behind price or abstract mathematical formulas divorced from market reality. Instead, his verification system is built on two fundamental pillars that reveal the actual behavior of informed money: price action and volume. This is where the real revelations begin. By carefully studying the relationship between these two elements, Wyckoff created precise tests that confirm whether a breakout is legitimate or merely another deceptive maneuver. His approach is almost forensic in nature, examining the evidence left behind by large operators as they execute their campaigns. When you learn to read these clues properly, the market's narrative becomes clear. You'll see not just what's happening, but why it's happening and who's making it happen. This level of insight fundamentally changes your market mindset from reactive to proactive, from guessing to knowing. The beauty of Wyckoff's verification system is how it eliminates uncertainty at the exact moment most traders feel most confused. By establishing objective criteria for judging the validity of a breakout, you're no longer at the mercy of market noise or your own emotions. You can identify with precision the exact moment when the path of least resistance has turned definitively upward. The impact of this knowledge is difficult to overstate. Imagine standing at the starting line of a major uptrend, positioned exactly where smart money has already completed its accumulation phase, with objective confirmation that the markup phase is about to begin. This is the power behind Wyckoff's approach to breakout verification. Now, I want to go even deeper into understanding exactly what these verification tests look like and how they work together to create a complete picture of market intent. The specific characteristics of price movement during a genuine breakout tell us volumes about the strength of the demand behind it. If you're starting to see markets differently after understanding these manipulation tactics, write in the comments, "I see the composite man now." To truly understand breakouts, we must first grasp what happens before them. This crucial preparatory stage, the accumulation phase, is where the real behind-the-scenes work takes place, far from the spotlight of public attention. Accumulation represents a profound transformation in a stock's ownership structure. It's the methodical process through which informed interests patiently absorb the floating supply within a trading range. Think of this as a transfer of power, shares moving from weak, uninformed hands into strong, patient, informed hands. This sideways price channel creates the foundation from which all meaningful advances must emerge. What's fascinating about these trading ranges is how they're formed. The lower boundary, the support line, is typically established by what Wyckoff called a selling climax. This is that dramatic moment when public panic reaches its peak. Fear dominates the narrative, negative headlines abound, and the last desperate sellers capitulate, throwing their shares away almost regardless of price. It's precisely at this emotional climax that smart money steps in, recognizing value where others see only danger. The upper boundary, the resistance line, is usually defined by the subsequent automatic rally that follows the selling climax. This initial bounce creates the parameters within which the accumulation campaign will unfold, often over many weeks or months. Within this confined battleground, the composite man works with remarkable patience to build what Wyckoff termed his line of stock. This accumulation journey requires a disciplined mindset that few retail traders ever develop. He strategically buys on weakness, on reactions down to the support line, gradually increasing his position without driving prices higher prematurely. One of the most brilliant aspects of this strategy is psychological. The composite man deliberately allows the stock to appear dull and lifeless, creating the illusion of a directionless market. This is a calculated decision designed to discourage public interest and exhaust any remaining weak holders who bought prematurely. The lack of excitement and apparent lack of progress causes many traders to abandon the stock in search of more immediate gratification elsewhere. But for those who understand the hidden truth of market structure, this seemingly boring phase reveals critical revelations. The savvy Wyckoff analyst watches for two key signs that successful accumulation is taking place. First, the gradual drying up of volume on declines, signaling the exhaustion of supply, and second, the tendency for reactions to halt at progressively higher lows, indicating the increasing eagerness of buyers. Subscribe now to continue your journey into market psychology. We're dedicated to breaking down these timeless trading principles that most retail traders never discover. These subtle clues are like footprints in the sand, revealing the presence and intentions of smart money even when they're trying to conceal their actions. When you train your eye to recognize these patterns, you'll start to see accumulation taking place across markets in real time, allowing you to position yourself alongside the market's most informed participants. The most powerful insight here is understanding that by the time a stock is ready to break out, the real opportunity hasn't just begun. The smart money has already completed most of its buying campaign. They've quietly accumulated their positions while most traders weren't even paying attention. If you've noticed these accumulation patterns forming in stocks you're watching right now, type "building my line" in the comments. Now we arrive at the dramatic climax of this accumulation campaign, what Wyckoff colorfully termed the jump across the creek. This vivid metaphor perfectly captures the essence of a genuine breakout moment and creates a powerful visual framework for understanding market structure. Imagine the upper resistance line of the trading range as a creek, a significant barrier that has consistently turned back every previous attempt to cross it. For the entire duration of the accumulation phase, rallies have approached this boundary only to be rejected, creating a clear ceiling that most traders come to accept as an immovable obstacle. This perception is precisely what the composite man wants you to believe, but behind the scenes, a transformation has been occurring. As supply diminishes through patient accumulation, pressure builds like water behind a dam. When the composite man has finally absorbed enough of the floating supply, he's ready for his campaign to enter its next phase, the public markup, where prices will be engineered significantly higher. The jump across the creek is that decisive moment of revelation when price finally breaks. Free from the confines of the trading range, it's not a gradual, uncertain process, but rather a powerful movement that carries the stock definitively above and away from the resistance that has contained it for so long. This event signals the official end of accumulation and the beginning of the markup phase. The hidden truth about genuine breakouts is that they carry distinct signatures that reveal the conviction behind them. These are not timid or hesitant affairs. When you observe a breakout on your charts, it manifests as a decisive, often sharp advance, characterized by a marked widening of the price spread, the distance between the high and low of the price bar. This expanded range reflects an important shift in market psychology. The stock begins covering ground easily, pushing into new high territory with a sense of energy and purpose that's unmistakable once you've learned to recognize it. This quality of movement, this character of price action, tells you something profound about the underlying market dynamics. Demand is now fully in control and is meeting little to no opposition. The journey from contained to uncontained price movement represents a fundamental change in the balance of power. A stock that struggles to clear resistance, inching above it on narrow price bars and then stalling, is not displaying the characteristics of a powerful breakout. Remember, the composite man has spent months preparing for this move and will not allow it to be timid or uncertain. His intention at this stage is to attract attention and create a following. He wants to leave sellers behind and draw in new buyers who will propel prices higher, allowing him to sell his accumulated position at increasingly favorable prices. The decisive nature of the price action must reflect this intent. It's the visual evidence that control has shifted decisively. Understanding these visual cues creates an entirely new dimension to your chart reading abilities. However, while our price action provides the initial visual signal, we need additional confirmation to truly verify the power behind a breakout. This is where volume enters the picture. If you've experienced that aha moment, seeing how breakouts reveal the composite man's intentions, comment "Creek Jumper" below. While price action provides the visual evidence of a breakout, volume delivers the crucial confirmation that transforms a mere price move into a meaningful market signal. This is where Wyckoff's brilliant law of effort versus result comes into play, one of the most profound revelations in all of technical analysis. This third fundamental law states that a significant result, such as a breakout into a new uptrend, must be accompanied by a significant effort. In market terms, the effort is represented by volume, while the result is reflected in price movement. When these two elements align harmoniously, we receive powerful confirmation of market intent. A true jump across the creek must therefore occur on a distinct and substantial expansion of trading volume. This surge in volume isn't just a technical indicator. It's the irrefutable proof that powerful demand has entered the market. It represents several forces acting in concert to create an overwhelming buying pressure that can overcome any residual supply at the resistance level. First, it reflects the composite man himself, now aggressively bidding for stock to propel it out of the range. Second, it captures the covering of short positions from bearish traders who are now trapped and forced to buy. And third, it includes the first wave of buying from other professional traders who recognize the technical signal and are joining the move. This confluence of demand creates the high-volume signature that validates the breakout. The psychology behind this relationship runs deep. Even a breakout that appears strong in terms of price movement but occurs on low or diminishing volume should raise immediate red flags. Such a divergence between effort and result suggests that the demand isn't powerful enough to sustain the move. These low-volume breakouts often prove to be false moves designed to trap the unwary before prices reverse. But the journey of verification doesn't end with the initial breakout. The market's path is rarely straightforward, and Wyckoff understood this with remarkable clarity. This brings us to the second verification stage, what he called the backup to the edge of the creek. It's relatively rare for a stock to launch into an uninterrupted advance immediately after breaking out. More typically, after the jump across the creek, there will be a pullback or period of sideways consolidation that brings the price back toward the level of the old resistance line. This backing up action serves as the final examination before the real markup begins. The revelation here is that this pullback, far from being a sign of weakness, actually represents a tremendous opportunity when interpreted correctly. It serves two critical functions in market structure. First, it's a final test of supply. If the breakout was genuine and the composite man is truly in control, very little stock should be available for sale during this pullback. Second, it shakes out short-term traders who bought in the initial excitement and are now taking quick profits. The defining characteristic of a successful backup to the edge of the creek is a dramatic shrinkage of volume as the price recedes. This diminished volume is the conclusive proof that sellers are exhausted. The former resistance of the trading range has now transformed into support, a perfect demonstration of that classic market principle where roles reverse. If you're starting to see these volume patterns on your charts that were previously invisible to you, comment "Volume speaks truth" below. This complete verification process The high-volume breakout followed by a low-volume pullback represents Wyckoff's two-stage confirmation system. It's a powerful blueprint for identifying genuine buying opportunities. But equally important is understanding the opposite scenario, the deceptive false breakout that Wyckoff termed an upthrust. The upthrust is perhaps the most psychologically devastating maneuver in the market operator's arsenal. It's specifically designed to do the exact opposite of a genuine breakout. Instead of signaling the beginning of a markup campaign, its purpose is to trap bullish traders and create fresh supply for distribution. It's a clever illusion that preys on the market's collective anticipation and impatience. The revelation here is that upthrusts don't just happen randomly. They're calculated moves that typically occur after a long advance within a distribution range, but they can also appear as deceptive moves out of what appears to be an accumulation range, making them particularly treacherous for the unwary. Wyckoff provided clear criteria to distinguish an upthrust from a genuine breakout, with the most telling sign often found in the volume signature. An upthrust typically manifests in one of two ways. First, the price may push above resistance on conspicuously low volume, demonstrating a lack of genuine demand. This move has no real power behind it. It's an effort without force, doomed to fail as soon as any meaningful supply appears. Second, and more deceptively, an upthrust can occur on a sudden burst of very high, almost climactic volume, but the price makes remarkably little upward progress before stalling. This divergence reveals the hidden truth. The great effort, high volume, is failing to produce a corresponding result, sustained price advance. This indicates that the apparent breakout is being met with massive selling from the composite man, who is using the public's excitement as an opportunity to distribute his shares at premium prices. Following either type of upthrust, the price quickly surrenders its gains and falls back below resistance into the old trading range. This failure to hold above the breakout level is the definitive proof that the move was false, a manipulation rather than a genuine change in trend. The journey doesn't end once you've successfully identified a genuine breakout. The task now transforms from detection to navigation, skillfully following the developing uptrend or markup phase for as long as the path of least resistance remains definitively upward. This requires a different set of analytical skills, akin to shifting from the role of detective to that of campaign manager. Your objective becomes distinguishing between healthy, normal reactions and the first subtle signs of weakness or distribution. You must learn to manage risk effectively, protect accumulating profits, and recognize the key points within the trend that offer opportunities to increase your position. This is the art of following smart money, a discipline of patience, observation, and adherence to logical principles. The mindset shift required here is significant. You're no longer hunting for entry signals, but rather managing an ongoing campaign. You're riding alongside the composite man as he engineers the advance, staying in harmony with his intentions while remaining vigilant for any change in character that might signal his exit. If you're finally understanding why your previous breakout trades may have failed, write "breaking free from upthrusts" in the comments. The first step in following a developing uptrend is understanding what a healthy one actually looks like. According to the Wyckoff method, a true uptrend has a very specific anatomical structure. It displays a persistent and recognizable pattern of higher highs and higher lows, arranged in what we might call a stair-step progression. This seemingly simple pattern contains profound market wisdom. Each upward thrust or swing pushing the price to a new high demonstrates the buyer's power and conviction. Each subsequent pullback or reaction stopping at a higher level than the previous one reveals the buyer's eagerness and the notable absence of significant selling pressure. This stair-step structure serves as the backbone of the trend. its skeletal framework. The revelation here is that as long as this pattern remains intact, the underlying technical presumption is that the uptrend will continue. When you train your eye to recognize this signature, you'll develop an almost instinctive feel for the health of any trend. You're analyzing or trading, but the true transformation in your analysis comes when you apply Wyckoff's law of effort versus result to each of these swings. This is where the volume behavior in healthy uptrends becomes your most reliable behind-the-scenes indicator of the trend's internal strength or weakness. On the advances, as price moves to new highs, volume should ideally expand. This demonstrates that the effort, volume, is in perfect harmony with the result, price advance. It signals that demand remains robust and is easily overcoming the natural profit-taking that occurs as a stock moves higher. This expansion of volume on rallies is the market's way of telling you that the buying pressure remains intense and purposeful. However, the most critical revelation about a healthy uptrend, the hidden truth that most traders miss, concerns what happens during reactions or pullbacks. On each correction, the volume of trading must noticeably contract. This diminished volume during declines is perhaps the single most reliable sign that a trend remains in a strong technical position. The psychology behind this pattern runs deep. The reduced volume proves that the selling is not aggressive or urgent. It's not distribution from large informed interests who would know to sell in size. Instead, it represents passive, light profit-taking from short-term traders or weak hands who are easily shaken out of their positions. This lack of significant selling pressure allows the composite man and other strong holders to easily absorb these small offerings without disturbing the price structure. In fact, they often use these reactions strategically to add to their own positions, strengthening their control. The journey of following a trend therefore becomes an ongoing process of monitoring this critical relationship, expanding volume on advances and contracting volume on reactions. This continuous confirmation of demand's dominance provides the confidence needed to hold a position through normal pullbacks and ride the trend for a substantial move. When you understand this interplay between price and volume, you develop a sixth sense for detecting changes in trend character. If a reaction suddenly occurs on high or expanding volume, it serves as an immediate warning sign, suggesting that supply is entering the market in volume comparable to the demand seen on rallies. If this volume analysis has changed your perspective on how to read price movements, comment, "Volume tells the story" below. Within a major uptrend, it's rare for a stock to advance in a single, uninterrupted line. The markup phase naturally develops a rhythm of its own, a cadence of advances followed by necessary periods of rest. These pauses manifest as what Wyckoff colorfully termed reaccumulation zones, or more colloquially, stepping stones. These formations represent one of the most significant revelations in trend analysis. To the untrained eye, these sideways periods often look like potential tops, causing fear and uncertainty. Inexperienced traders frequently abandon perfectly healthy trends during these consolidations, missing the substantial moves that follow. But to the Wyckoff analyst, these stepping stones are actually highly bullish formations that represent a crucial part of the markup journey. The psychology behind these patterns runs deep. After a stock has made a significant advance, it naturally attracts profit-taking. Some early buyers are satisfied with their gains and sell their positions. This creates a temporary equilibrium between buying and selling forces, causing the price to move sideways for a period of weeks or even months. During these reaccumulation phases, the composite man is achieving several strategic objectives that strengthen his campaign. First, he's patiently absorbing the stock being sold by early buyers. Second, he's deliberately shaking out nervous or impatient traders who become frustrated with the lack of immediate upward progress. This methodical process of absorbing profit-taking and cleaning out weak hands allows him to consolidate his control over the stock and prepare it for the next leg of its advance. The transformation in mindset required here is substantial. Instead of fearing these consolidations, you learn to welcome them as necessary and constructive parts of a healthy trend. These stepping stones create the foundation for further advances and often provide excellent low-risk opportunities to add to an existing position, a practice known as pyramiding. To effectively visualize and manage the uptrend through these various phases, Wyckoff employed the practical tool of the trend line. This simple yet powerful concept helps traders maintain perspective on the overall direction and momentum. By connecting successive reaction lows, you create a visual representation of the trend's angle or stride. The revelation here is that this line serves not as an infallible signal, but rather as a tool to help you visualize changes in character. As long as the price remains above this line, the trend is considered intact. A break of the trend line isn't an automatic sell signal, but rather a critical warning that the trend's momentum is changing. This might simply indicate a shift to a more sustainable angle of advance after a steep rise, or potentially something more significant. For the practical management of positions during this entire journey, Wyckoff advocated a systematic approach using trailing stop-loss orders. This method embodies a powerful market principle: let profits run, but never give back a substantial portion of them. After each new high and subsequent reaction, the stop is moved up to just below the reaction low. If you're starting to see how these consolidation phases create opportunities rather than dangers, comment "stepping stone mindset" below. This method of trailing stops perfectly embodies the spirit of Wyckoff's entire approach. Systematic, logical, and designed to remove emotional decision-making from the equation. By placing your stop just below each reaction low, you're creating a simple yet powerful risk management system that protects capital while maximizing gains. When you implement these concepts together, verifying breakouts, following healthy uptrends, recognizing reaccumulation zones, and managing positions with trailing stops, trading transforms from an emotional roller coaster into a disciplined business. You're no longer trading on hope or fear, but on objective evidence of market structure. I hope this deep dive into Wyckoff's methodology has shed light on why so many breakouts fail and how you can distinguish the genuine opportunities from the traps. If you've found value in these insights, consider subscribing to the channel. We're committed to unwrapping these timeless market principles that have worked for over a century, because human nature and the way large interests manipulate markets hasn't fundamentally changed. The journey we've taken together through Wyckoff's methods represents just one layer of market understanding. There's so much more to explore in terms of how these principles apply to current markets, different timeframes, and various asset classes. If this analysis resonated with you, I'd appreciate if you'd hit the like button. It helps tremendously in sharing these ideas with others who might benefit. And if you've made it all the way through this exploration, type "Creek Jumper for Life" in the comments. I'd love to know who's dedicated to mastering these concepts. Right over here, you'll find our video on identifying distribution patterns, the perfect complement to today's discussion on accumulation and breakouts. Click on it to continue your journey into the world of Wyckoff analysis, where we'll explore how to recognize when smart money is quietly exiting the market.